Preparing for a Lowe's financial analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Lowe's? Lowe's appeals to me because it combines a recognizable consumer business with complex operational decisions. A financial analyst can influence assortment, pricing, inventory, labor, store productivity, and capital investment rather than simply report historical results. I also like the practical nature of home improvement, where customer demand, housing activity, weather, and professional contractors all matter. My strengths in financial modeling, variance analysis, and communicating recommendations would help leaders convert data into disciplined, commercially useful decisions. While answering, connect your analytical skills to retail economics, Lowe's home improvement customers, merchandise categories, operational scale, and the opportunity to support decisions involving sales, margins, inventory, stores, and capital allocation. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and profit over a period. Net income flows into retained earnings on the balance sheet and begins the operating section of the cash flow statement. The balance sheet captures assets, liabilities, and equity at a point in time, while cash flow explains the change in cash through operations, investing, and financing. For example, depreciation reduces earnings but not cash, whereas inventory growth uses cash and increases a balance sheet asset. These linkages keep forecasts internally consistent. Make sure to cover income statement profitability, balance sheet resources and obligations, cash flow reconciliation, retained earnings, non-cash expenses, working capital, and why analysts must reconcile the statements before trusting a model. Question 3. How would you forecast Lowe's sales? I would build sales from store count, comparable sales, and digital or other channel assumptions. Comparable sales would be decomposed into transactions and average ticket, then tested against housing activity, weather, promotional calendars, category trends, and professional customer demand. I would forecast major categories separately because appliances, seasonal products, and building materials behave differently. Finally, I would create base, upside, and downside cases, document each driver, and compare actual performance with the assumptions to improve future forecasts. In your answer, talk about store count, comparable sales, transaction volume, ticket size, housing and macro drivers, category mix, seasonal patterns, pro demand, digital sales, and base case, upside and downside assumptions. Question 4. What is comparable store sales, and why is it important for Lowe's? Comparable store sales measure sales growth from locations or channels operating in both the current and prior year periods. They help isolate underlying demand from growth caused by opening new stores. At Lowe's, I would examine comparable sales alongside transactions and average ticket because a positive result can reflect more customers, larger baskets, or pricing. I would also consider digital treatment, relocations, closures, and calendar effects. The metric is useful, but it should never replace margin, traffic, and cash flow analysis. Be sure to mention the purpose of comparable sales, the usual measurement period, transaction and ticket components, channel considerations, acquired or closed locations, and limitations when interpreting the metric. Question 5. How would you analyze a gross margin decline at Lowe's? I would bridge gross margin from the prior period by isolating pricing, product cost, mix, promotions, markdowns, shrink, freight, and fulfillment impacts. I would then identify whether weakness is concentrated in a category, channel, region, or customer group. For example, lower margin might reflect heavier seasonal clearance rather than broad pricing weakness. I would compare realized margin with plan, review vendor cost movements, and quantify corrective actions. The final recommendation should distinguish controllable issues from temporary market or seasonal effects. Focus on price and cost changes, product mix, promotions, markdowns, shrink, freight, vendor terms, inventory aging, fulfillment costs, and separating temporary pressure from structural deterioration. Question 6. What is operating leverage, and how could it affect Lowe's earnings? Operating leverage describes how fixed costs cause profit to change faster than sales. Lowe's has expenses such as store occupancy, technology, and certain corporate costs that do not move proportionally with daily sales. If sales rise, incremental revenue can produce strong operating profit growth after variable costs are covered. Conversely, weaker comparable sales can pressure earnings disproportionately. I would model contribution margins and fixed cost commitments to estimate sensitivity, then assess whether management can flex labor, promotions, or other discretionary spending. In your answer, explain fixed versus variable costs, contribution margin, sales sensitivity, store and corporate expenses, break-even behavior, and why operating leverage magnifies both upside and downside. Question 7. How would you evaluate Lowe's inventory performance? I would evaluate inventory using turns, days on hand, sell-through, aging, in-stock rates, and markdown exposure. A lower balance is not automatically better if it creates stockouts and lost sales, while excess inventory can consume cash and require clearance. I would analyze results by category because seasonal and bulky products have different replenishment patterns. I would also compare inventory growth with sales growth, investigate purchase order timing, and connect the findings to gross margin, working capital, and customer service. Make sure to cover inventory turns, days inventory outstanding, sell-through, in-stock rates, aging, markdown risk, category differences, seasonality, service levels, and the trade-off between availability and working capital. Question 8. What is working capital, and which components matter most in retail? Working capital generally includes operating current assets less operating current liabilities. For a retailer, inventory and accounts payable are usually more significant than receivables because the business buys merchandise before selling it. Higher inventory consumes cash, while extended supplier terms can support cash flow, provided relationships remain healthy. I would analyze changes relative to sales, seasonality, purchase timing, and turns. The objective is not simply minimizing working capital, it is balancing liquidity, availability, margin protection, and supplier reliability. Discuss receivables, inventory, payables, operating cash conversion, supplier terms, inventory planning, seasonal purchases, vendor financing, and why working capital changes can materially affect Lowe's cash flow. Question 9. How would you build a monthly budget versus actual variance analysis? I would begin by validating actuals, budget versions, period definitions, and account mappings. Then I would separate each variance into volume, price or rate, mix, timing, and one-time effects. For example, labor expense may differ because hours changed, wage rates changed, or staffing shifted between stores and departments. I would prioritize material variances, confirm explanations with operational owners, and translate findings into forecast changes or actions. Good commentary should explain what happened, why it happened, and what happens next. Be sure to mention a clear data hierarchy, volume and rate drivers, materiality thresholds, favorable versus unfavorable classifications, root cause ownership, forecast updates, and actionable commentary for business partners. Question 10. How would you assess a proposed Lowe's store remodel or capital project? I would estimate incremental sales, gross profit, operating expenses, required capital, maintenance spending, and the project's useful life. I would discount incremental after-tax cash flows to calculate NPV and compare IRR and payback with Lowe's hurdle rates. I would also test cannibalization, execution delays, construction inflation, and downside sales scenarios. A project can have strategic value through better customer experience or fulfillment, but I would quantify those benefits where possible and clearly distinguish measurable returns from qualitative considerations. In your answer, cover incremental sales, gross profit, labor and operating costs, CapEx timing, maintenance needs, cannibalization, payback, NPV, IRR, sensitivity analysis, and strategic customer benefits. Question 11. What financial metrics would you monitor for Lowe's? I would monitor comparable sales, transactions, average ticket, gross margin, operating margin, SG&A leverage, inventory turns, shrink, and free cash flow. I would also track digital sales, fulfillment performance, pro-customer trends, and return on invested capital because financial results must connect to customer and operational drivers. Metrics should be reviewed against plan, prior year, and relevant benchmarks. I would avoid viewing any metric in isolation. For instance, stronger sales may be unattractive if promotions destroy margin or inventory productivity. Focus on comparable sales, transactions, average ticket, gross margin, operating margin, inventory turns, shrink, labor productivity, digital penetration, free cash flow, return on invested capital, and customer or pro metrics. Question 12. How would you explain a forecast miss to senior management? I would explain the miss directly, quantify its impact, and separate forecast errors from unexpected business events. For example, I might show that sales were below plan because transactions declined in specific seasonal categories, while margin held due to lower markdowns. I would identify which assumptions were wrong, what information was unavailable, and what controls can improve the process. Then I would provide a revised forecast, downside and recovery scenarios, and specific actions with owners and deadlines. Make sure to cover ownership, concise facts, driver-based analysis, materiality, accountability, corrective actions, revised assumptions, scenario ranges, and avoiding defensiveness or unsupported explanations. Question 13. How would inflation affect Lowe's financial performance? Inflation can increase reported sales through higher prices while reducing unit demand and changing customer mix. It can also pressure product costs, wages, freight, and occupancy. I would analyze price, volume, and mix separately, then assess whether price increases preserve gross margin without damaging traffic or competitiveness. Inventory timing matters because goods purchased at older costs may temporarily support margin. I would also model supplier negotiations, wage inflation, and promotional responses so management understands both earnings and cash flow implications. Discuss product costs, retail pricing, consumer demand, mix, wages, freight, shrink, inventory valuation, margin timing, supplier negotiations, and the difference between nominal sales growth and real volume growth. Question 14. How would higher interest rates affect Lowe's? Higher rates can weaken housing transactions and discretionary renovation demand, particularly for projects linked to moving or financing. They may also raise borrowing costs, affect consumer credit behavior, reduce valuation multiples, and increase the opportunity cost of capital investments. However, homeowners who cannot move may invest in existing homes, creating offsetting demand. I would model category-specific sales sensitivities, financing costs, and cash flow effects under several rate scenarios, then monitor leading indicators such as housing turnover, permits, and credit trends. In your answer, connect rates to housing activity, renovation demand, consumer financing, borrowing costs, lease economics, valuation, capital allocation, and scenario analysis rather than assuming one uniform effect. Question 15. Tell me about a time you used data to improve a business decision. In a prior project, monthly reporting showed labor costs above budget, but the headline variance did not explain the cause. I combined staffing hours, wage rates, sales, and store-level schedules, then found that overtime was concentrated in a few high-volume periods. I recommended shifting schedules and setting an exception report for recurring overtime. The team adopted the change, reducing overtime while maintaining service levels. That experience taught me to move from a financial variance to an operational driver and actionable decision. Be sure to structure the response with situation, task, analysis, recommendation, implementation, measurable result, and lesson learned, emphasizing how you communicated technical findings to non-finance stakeholders. Question 16. How would you prioritize competing requests from merchandising, stores, and corporate teams? I would first clarify the decision, deadline, required precision, and financial impact for each request. A time-sensitive forecast affecting inventory or an executive decision would generally take priority over a lower-impact analysis. I would communicate trade-offs early, provide an interim answer when appropriate, and protect time for validation. I would also use repeatable templates and automate routine work where possible. The goal is not treating every request identically, it is allocating analytical effort where it can most improve business outcomes. Focus on business impact, urgency, strategic alignment, decision deadlines, materiality, data availability, stakeholder communication, transparent trade-offs, and maintaining accuracy when priorities shift. Question 17. What controls would you use to ensure financial reporting accuracy? I would establish a controlled process with reconciliations to the general ledger, validated source data, documented formulas, version control, and independent review of material outputs. I would use reasonableness checks against prior periods, budgets, operational statistics, and expected relationships. Access and approval responsibilities should be separated where practical, with a clear audit trail for adjustments. If I identify an error, I would quantify it, notify the appropriate owner promptly, correct the source or report, and document the preventive control. Mention reconciliations, documented review procedures, segregation of duties, version control, source system validation, exception reports, reasonableness checks, audit trails, and prompt escalation of errors. Question 18. How do leases affect Lowe's financial analysis? Leases represent important long-term commitments for stores and distribution facilities. Under current accounting, operating leases generally create right-of-use assets and lease liabilities, while lease expense is recognized over the term. For analysis, I would review both reported expenses and contractual cash commitments, especially when comparing EBITDA or leverage across retailers. I would assess renewal dates, escalations, closure obligations, and location economics. A store can appear attractive operationally but still destroy value if its lease burden and required capital are overlooked. In your answer, cover store and distribution center leases, right-of-use assets, lease liabilities, rent expense, EBITDA interpretation, cash commitments, renewal risk, and comparing leased versus owned locations. Question 19. How would you evaluate an investment in Lowe's omnichannel capabilities? I would evaluate omnichannel investment through incremental sales, conversion, repeat behavior, fulfillment cost, delivery expense, gross margin, and customer lifetime value. I would distinguish sales shifted from stores from genuinely incremental demand. The model would include technology and infrastructure capital, labor, returns, implementation timing, and service level benefits. I would test adoption and cost assumptions under multiple scenarios and monitor payback after launch. The right decision balances near-term profitability with strategic benefits such as convenience, retention, and stronger store fulfillment. Discuss incremental sales, digital conversion, fulfillment costs, delivery economics, customer retention, store productivity, technology capex, cannibalization, implementation risk, and measurable return thresholds. Question 20. What would you do if your analysis conflicted with a senior stakeholder's expectations? I would first recheck the data, definitions, formulas, and assumptions to ensure the disagreement was not caused by an avoidable error. Then I would ask the stakeholder what business context or information I might be missing. I would present the analysis transparently, separating facts, estimates, and sensitivities rather than becoming defensive. If assumptions drive the difference, I would show alternative cases and their implications. After alignment, I would document the agreed approach and escalate only when a material control or integrity issue remained. Be sure to mention checking data and assumptions, listening to the stakeholder, presenting evidence respectfully, identifying sensitivities, distinguishing facts from judgment, documenting conclusions, and escalating only when necessary. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.